Hi, everybody. Welcome to today's webinar. We have a really big presentation for you today, a really important topic to cover. We've got 5 attorneys with us today from Cozen O'Connor. I'm super excited to talk about this. We're covering the Secure 2.0 Act today, and it's a really complex topic. So we're only going to be able to scratch the surface today, but we'll be covering this topic more in the future. So look out for updates, but we're going to go over the most important stuff that we can cover today. With that said, for the sake of time, I'm going to include an extended bio for all of the attorneys joining us today in the follow-up email that will go out tomorrow, so you can get to know them a little bit better there. The follow-up email will have a recording of this presentation. It will have a copy of these slides because this is really great information to have, and it will have the credit codes. So keep your eye out for that tomorrow. I'm sure most of you are familiar with HR Simple, but for the people who are new here, we work with the top attorneys around the United States, like Cozen, to provide HR manuals in a print and online version. We also do webinars like this 2 times a month, and webinars are included with every purchase. So if you're interested in that, you can go to hrsimple.com/solutions. And with that said, I'm going to introduce everybody that's joining us today from Cozen O'Connor. So we have Matt here, Matt Clyde from Pittsburgh, Lynn Brehm from Charlotte, North Carolina, Rob Kaplan from Philadelphia, Jenna Schaffer from Philadelphia, and Jay Dorsch from Philadelphia. So Jay, are we ready to do this thing?
We are. Okay.
Welcome, guys.
First slide. Can we go to the first slide?
Yes. There we
Great.
go.
Good afternoon, everybody, and thanks for joining us. As Amy said, today's seminar is going to be discussing the Secure Act 2.0 and how it affects employers. The act was signed at the very end of the year on December 29th, 2022. It's kind of a landmark piece of legislation having over 90 changes impacting retirement plans. And given that we've got about an hour to speak, we clearly aren't going to be talking about all of them. So without further ado, I'm going to have us get started with Matt Clyde, who's going to start talking about auto-enrollment. Matt?
Yeah, thanks for kicking it off, Jay. So we're going to first talk about auto-enrollment that was implemented as part of the Secure Act. And auto-enrollment is something the IRS and the Department of Labor have been pushing and promoting for many, many years. Well, finally, with the Secure Act, we got it into legislation, and so now it's required. It's a mandated provision for retirement plans. Now, there is an important element to the auto-enrollment rules that old and prior plans that were in existence on the date the Secure Act was passed, which was December 29th, 2022. All of those plans are grandfathered in, and none of the auto-enrollment rules apply. And so if you're sitting here with an existing 401k or 403b plan, and your plan is already in existence, these rules aren't really going to apply to you. But if going forward, a plan is adopted, these auto-enrollment rules do affect you. And there are a couple other exceptions as well, other plans that it doesn't apply to: governmental plans, church plans, and plans that have an employer with 10 or few employees. Small employers are also exempt. Now, how does a plan comply with the new auto-enrollment rules? Well, starting in 2025, and that's another odd tweak to this. First, the rules only apply to plans adopted on or after December 29th, 2022. So it's really only plans adopted going forward, but then the rules don't even apply immediately. They don't actually kick in and start applying until 2025, the first plan year that starts after January 1st of 2025. And what it means is any employee who meets the eligibility rule under the plan have to be brought into the plan at a minimum deferral or contribution rate of at least 3%. And then in addition, every year thereafter, there has to be an annual increase in that employee's deferral or contribution rate of at least 1% up until the employee hits a deferral rate of at least 10%, and you can continue auto increasing, or what they call the auto escalate, up to 15%, but no more than 15%. So you got to bring them in at 3% automatically, bump them up 1% each year till you get them to 10%. And then you can keep bumping them to 15%, but you got to get them to at least 10%. That's the auto enroll, auto escalation features in a nutshell. One important thing to keep in mind, now I'll go back real quick before we go to the student loan slide. One important thing to keep in mind is if an employee makes an election, so we hire a new guy, they're brought in to the plan under the auto enrollment feature, and they're automatically enrolled 3%. If that employee then, or participant, I should say, steps up and files an election and says, hey, I want to defer at 5%, that election overrides the auto enrollment and the auto escalation feature. So that employee stays at 5% and you don't bump that employee 1% each year. Similarly, if an employee makes an election, say, I want to contribute at 0%, I don't want to contribute at all, then you don't implement the auto escalation 1% bump each year. All right, let's move to the next slide on student loan repayments. This was another change that came about in Secure Act 2.0. Student loan repayments, something that the IRS has toyed with in the past couple of years. In fact, in 2018, the IRS issued a private letter ruling to one single employer, where that employer was trying to help their employees out who were saddled with severe student loan debt. And so the IRS made an exception for one specific employer. It was not broadly applicable, didn't apply to every employer. Well, in the Secure Act, that guidance was really opened up to all employers. It's a optional provision. Employers are not required to do this, but if employers so choose, starting in 2024, an employer can amend their retirement plan, a 401k, 403b, or a simple IRA arrangement to allow student loan repayments that are being paid by their employees to treat those student loan repayments as though those repayments were actually contributions to the 401k plan, and then make a match based on as if that employee had made a contribution to their plan. So if you've got an employee who's not contributing to their 401k plan because they're so busy paying down their student loan debt, you can go to that employee and say, well, how much are you paying annually on your student loan? And then treat that amount that they're paying on their student loan debt as if they made a contribution to their 401k, and then the employer can make a match. Now, student loan debt's pretty broadly defined. The Secure Act was pretty generous here. Really, any debt incurred in pursuit of higher education. So it doesn't just have to be debt that was for tuition, but even if an employee had borrowed money for housing, for other expenses, if it's in pursuit of their student and higher education, it's going to probably meet the definition of student loan debt. And employers just are allowed to rely on a certification from the employee. They don't have to go dig and confirm, the origins of that debt. Again, it's an optional provision, not required. I don't know how many employers will take advantage of it. My guess is not a whole lot, but it's out there now, starting in 2024. Let's move to the next slide. This is a big one. Oh my goodness, Roth contributions. Many plans don't have Roth contributions. This provision is going to change that. Going forward, I think we're going to see virtually all plans have a Roth feature now. So let's talk about what is a Roth contribution to make sure we're all on the same page. I'm sure most of you know, but for those of you who don't maybe remember, a Roth contribution is different from a normal contribution to a 401k plan, because a normal contribution an employee makes and does not pay tax on. They defer to their 401k plan, they make a contribution to their 401k plan, and they don't pay income tax on that amount. In fact, they don't pay income tax until they receive a distribution out of their 401k account, hopefully in retirement. Now, on the other hand, what is a Roth contribution? The employee first pays tax on their income. Then after they pay tax on their income on a post-tax basis, they then contribute to their 401k plan. So those monies that they contribute on a Roth basis, those monies have already been taxed. The employee has paid income tax on it. Now that money is sitting in the plan in a Roth account on a post-tax basis and growing. If you comply with the Roth rules, eventually when the employee takes the distribution of that Roth contribution plus all of its earnings, all of its income growth, is distributed tax-free. The employee doesn't have to pay income tax. That's the benefit of a Roth contribution. So how does this come into play? Well, what it really affects is highly compensated employees. This new rule under the Secure Act really affects highly compensated employees. Well, who's that? Well, that's people that are making $145,000 or more in the prior year. And so if you've got any employees who were making $145,000 or more in a prior year, and those employees were making catch-up contributions. Well, what's a catch-up contribution? We're probably familiar with that. If you're 50 or older, the tax code is always allowed, I shouldn't say always, but for many years has allowed a catch-up contribution. I think it's $7,500 this year. Those amounts are being increased under the Secure Act. I think Rob will be talking about that later on. But if you've got somebody who's over 50 and who's making those catch-up contributions each year, so they max out their 18 or 19.5, I think it is, that they can contribute, and they're doing the 7,500 catch-up amount. That catch-up amount is what these rules apply to. And if a highly compensated employee who's making more than 145 is also making a catch-up contribution, that catch-up contribution has to be on a Roth basis. It cannot be on a pre-tax basis. So what that means is if your plan has a catch-up contribution, and most plans do have a catch-up contribution feature, but your plan does not have a Roth feature, if you want to keep your catch-up contribution feature for your highly compensated employees, you're going to have to add a Roth arrangement to your plan so that the highly compensated employees who are doing catch-up contributions can make those catch-up contributions as a Roth contribution. This is mandatory. So again, if you have a catch-up contribution feature in your plan, you're going to have to add a Roth feature. This goes into effect in 2024 and plan years after. Let's move on. One more topic on the Roth idea. There's an idea of Rothifying vested matching contributions. If employees, and this applies to all employees, not just highly compensated employees, but any employee has an account in the plan that is a matching contribution account or a non-elective employer contribution account. Those amounts, again, the employee does not pay tax on those. If the employee makes an election to, quote, Rothify those matching contributions, the employee will be treated as though they had taxable income. And so they will have to pay income tax in that year on the amount that they Rothify. So this works if I give you an example. Let's say an employee has $50,000 in their 401k account, and 10,000 of it is matching contributions that are vested. The employee says, I want to Rothify those $10,000 that are that $10,000 that's in my account that is a matching contribution. If the employee Rothifies that and makes the election to Rothify that $10,000, they will pay income taxes though they'd received income of $10,000. Now that $10,000 that's in the matching contribution becomes a Roth contribution and is now sitting in the account. It's already been taxed. The employee's paid tax on it. And eventually when the employee withdraws that amount, those matching contributions that have been Rothified, the employee gets to take that distribution tax-free. These new rules, again, are optional. You don't have to add them, but if you do, you've got to amend your plan. They go into effect immediately. So they went into effect December 29th, 2022. It's an optional change that employers can add to their plan. Moving on to the next slide, I'm moving fast. I'm running out of time. 403B plan changes. 403B plans, if you've got a not-for-profit governmental employer that's sponsoring a 403B plan, Secure Act allows multiple employers to contribute and participate in a multiple employer 403B plan. That's a new change. Previously, we're all familiar with multiple employer 401k plans. Now it's open up to 403B plans. This allows small governmental employers and nonprofit employers to get into 403B plans. The one bad apple rule was eliminated. This doesn't go into effect, or this went into effect January 1st of this year. And I think I'm out of time, so we're going to move it on to Lynn Brehm.
Thank you, Matt. Next slide, please. So I'm going to discuss some updates to the IRS Employee Plans Compliance Resolution System, which I'll be referring to as EPCRS. While I know the title can tempt you to want to tune me out because anything about an IRS program can sound pretty boring, I'm going to explain to you over the next few minutes why these programs are actually an excellent opportunity for plan sponsors and can actually save you a lot of money. But first, I want to give a little background because I know some people may not have ever used EPCRS. What EPCRS does is it's set out, if you ever want to read the provisions, and they're very specific provisions, it's set out in IRS Revenue Procedure 2021-30. So if you just put into Google or any other search engine, that revenue procedure, it will pull up. What you want to keep in mind, however, is anytime EPCRS is updated, it will actually show up in a new revenue procedure. So in 2 years, when it's to be updated for these most recent Secure Act changes, it will no longer be in 2021-30. So going there will not give you these updates. So what EPCRS actually does is offer plan sponsors the opportunity to correct mistakes with the administration of their retirement plans. This is whether it's a plan document failure, which a plan document failure is when there's something about your plan language that isn't correct, or an operational failure, which is when something about the way you administered your plan isn't correct. Now, the reason this is an important tool for plan sponsors is it actually allows plans to avoid the consequences of plan disqualification, which are some pretty severe tax penalties that would occur if the failures were not corrected and then the failure was later discovered during an IRS audit. So EPCRS sets out specific corrections for various failures, and then it sets out 3 processes that can be used to correct the failures. The most common and the favorable one, which we'll focus on today, is self-correction. And this is where you identify a failure, you go to EPCRS and you correct it in the way it's set out, and you don't have to do anything further. You don't have to report that to the IRS. Voluntary correction is where you find a particular error and then you report it to the IRS and you pay a fee for doing so. The final one is the audit closing agreement program. I'm actually working on this with a client right now. And this is where a failure is discovered during the audit process. Then you have to pay a pretty hefty sanction. And at that point in time, you go about and correct it so that you don't have a disqualification error. Now, something to point out is these failures, and we'll just call them administrative failures overall, are actually more common than people realize. And oftentimes it's not even you that creates the problem. If you have a third-party administrator of your plan, they often are the ones that cause these errors. But because it's your plan, you're the one legally required to address it. They will often work with you, but they'll look to you to say how. So I want to point that out, that even if you do everything right, if your third-party administrator does not, you still may have to be correcting it. Next slide, please. So this is one of what I believe the most exciting parts of the EPCRS changes, which is the expanded use of self-correction. As I mentioned earlier, the importance of self-correction is you don't need to report it to the IRS. And no one wants to step forward to tell their IRS they've done something wrong, because it opens up their plan for the IRS to look at anything further as well. So that historical aspect of it is what makes it so exciting now that more failures can be corrected. So previously, the only failures that could be corrected by self-correction were either insignificant failures, which were specifically defined in a list of circumstances and factors, at any time, or if the failure was significant, you actually had to correct it within a 3-year time period of when it first occurred. And a lot of times errors aren't found until years down the road. So under Secure Act 2.0, EPCRS significantly expanded this, except for 2 very specific situations. If a failure was identified by the IRS during an audit and prior to the plan sponsor taking actions, and this is how they define it, which demonstrate a specific commitment to implement a self-correction with respect to such failure, that could not be self-corrected. There is not a clear definition as to what demonstrating a specific commitment means. So we can't look and say, when does that happen? So as soon as you find an error, start correcting it. You also can't self-correct if you find an error, but you don't complete it within a reasonable period of time. So let's say you discover it, but it's in the middle of a busy season and you don't pick it up, and next thing you know, it's a year later. Now, the thing to point out about that is, again, there's not a definition for reasonable period. So the only way you would wind up in a problem with self-correction is if you self-corrected, the IRS later audited your plan, found the self-correction and said it wasn't timely. So that's not likely to be a big problem, but I just wanted to mention that. Next slide, please. You're now probably asking, well, what's an eligible inadvertent failure? The EPCRS system defines it as a failure that occurs despite the existence of practices and procedures which satisfy standards that are set out in Section 404. That just means you're required to have practices and procedures, whether they're formal or informal, that are reasonably designed to promote and facilitate overall compliance in former operation with the applicable code requirements. So the idea is you're supposed to have something in place that works towards complying with the law. But the IRS recognizes that sometimes that just doesn't happen. And as I said earlier, it might not even be your fault. It might be the third-party administrator. So that's why this program was put in place, to encourage employers to step forward and correct these errors. They have specifically defined, however, what is not an eligible inadvertent failure, and that includes anything egregious, anything that relates to the diversion or misuse of plan assets, or anything that's directly or indirectly related to abusive tax avoidance transaction. The way to summarize that is to say, if you're doing something that you know is a failure, you cannot later use correction to fix it when you have more time to do so. So the IRS is going to issue guidance on correction methods that are required to be used to correct these eligible inadvertent failures, including certain principles of correction to follow, but that's not required to happen for 2 years. So in the interim, you need to use good faith in applying that. Next slide, please. So to expand on this use of self-correction, one very specific aspect that has been clearly made available for self-correction now are loan errors. This is a big deal because before Secure Act 2.0, many loan failures were not permitted to be self-corrected, even if you knew how to do so. In other words, you had to report them to the IRS. Now, when you correct an eligible inadvertent failure related to a loan, you actually no longer need to report it as a deemed distribution on a Form 1099-R. This is a big deal, particularly for your participants who it was going to affect how they had to be taxed on something that has since been corrected. Another really big change, and this one's really important, it's now said that the DOL will treat any loan that's properly self-corrected under EPCRS as meeting the requirements of the DOL Voluntary Fiduciary Correction Program. Without this being stated, you could potentially have to file under both the DOL and an IRS program. Now, the DOL is going to come out with more guidance on to what they'll expect there, but that's a very positive thing for plan sponsors and actually employees as well. Next slide, please. EPCRS has also expanded who can use the system. Previously, it was just tax qualified plans, which are 401k, defined benefit plans, which are 401a plans, and then 403b annuity plans. But now it's been expanded to allow EPCRS to be used by IRAs, simple IRAs, and simplified employee pension plans. This really gives small employers an opportunity to use this program when they previously did not have that opportunity. Next slide, please. So before Secure Act came out, there was a safe harbor that allowed employee elective deferral failures, which that just means when an employee made an elective deferral and it wasn't properly implemented. If that happened under an automatic enrollment plan, it could be corrected if certain requirements were met. The problem was it kept sunsetting. You had this provision, it could be corrected, it would sunset, meaning it was no longer applicable, then it would be renewed, and this kept going back and forth. Under Secure Act 2.0, this is now a permanent provision. What makes this so positive is if employers meet these requirements, they actually don't have to make up missed elective deferrals and only have to make up any match if there was any match. Now, this still needs to be corrected within a 9.5-month period. So when I talked earlier about significant versus insignificant and time periods no longer mattering, it does for this particular safe harbor. The other important thing that came out is this safe harbor can actually be used now, even if the failure affects people who have since been terminated. And this correction is available even if the failure is identified by the IRS in an audit. So they're still willing to allow you to do this correction process if it's within that 9.5-month time period. There are other requirements as well about notifying participants, and those details do exist in Revenue Procedure 2021-30. Next slide, please. So these provisions that I just went through with EPCRS actually are already in effect. They took effect when Secure Act was enacted December 29th of 2022. But the actual EPCRS procedures have not yet been updated. So if you find that you have a failure, whether you, again, had it yourself or through a third-party administrator, keep in mind that you don't just want to look at the EPCRS procedures, you want to look at the Secure Act guidance before those EPCRS procedures are updated. Until EPCRS is updated, there's still some question as to what will be required, but you can continue to move forward with good faith in what's presented at the time. Next slide, please. Another change that technically wasn't identified as a change to EPCRS, but has in fact changed EPCRS is what happens with the recovery and correction of overpayments from the plan. I have actually, since this came out, talked to 2 different clients that this has affected. Overpayments are any time a payment is made from the plan when it should not have been. Previously, in almost every situation, you had to recover that overpayment. Whether you recovered it from a participant or a third party, it may have been at fault, you had to do so. Now, both ERISA and the Internal Revenue Code set out that you do not have to recover that overpayment if it's an inadvertent benefit overpayment. You still can, but if you do move forward with recovering it, there are particular requirements now. For instance, you cannot charge interest to participants. Employers are still obligated to make minimum funding contributions. So if you were to have overpayments that affected that, you would still need to make those. And you have to restore any impermissible forfeitures. And you also are still required to recover any overpayments if the reason for the overpayment was not complying with 401A-17, which are the limits on employee deferrals to a plan, and 415. In all cases, nothing relieves the fiduciary from responsibility for an overpayment that resulted in an actual breach of their fiduciary duties. Next slide, please. So the effective date is the same as it was for the EPCRS procedures. They took effect immediately. However, if you are going through a process where overpayments are currently being recovered from participants, it's been made clear that you can continue to do so. You just need to apply these provisions going forward. Rob is now going to present to you on increases in catch-up contribution limits.
Thank you, Lynn. One of the neat provisions of Secure 2.0 is that beginning in 2024, they are increasing the rate of catch-up contributions for participants who are between ages 60 and 63. If you're not familiar with catch-up contributions, participants who are in a 401k or 403b or 457b who are age 50 or older can contribute an extra amount to the plan over and above the regular contribution limit. For 2023, this catch-up limit is $7,500. Secure 2.0 adds a new provision that for participants between ages 60 and 63, the catch-up rate is being increased to 150% of the regular catch-up rate. This limit goes up with inflation, so we won't quite know how much money this will be when it starts in 2024, but based on the regular 2023 catch-up limit, that means that folks who are between the ages of 60 and 63 will have a catch-up limit of $11,250, which is 150% of the current $7,500 limit. So it's nice that they're giving people who are getting closer to retirement another opportunity to put in some extra money for themselves into their retirement plan. Next slide, please. The next change we wanted to mention was the changes to the long-time part-time employee coverage requirements for retirement plans. This is one that needs a bit of an explanation. I think will be pretty confusing for employers out there, so we want to take some time to explain it. For background, before the original Secure Act was passed in 2019, many 401k plans effectively kept part-time employees out of those plans by having an hours requirement, where employees needed to complete at least 1,000 hours of service during a 12-month period in order to become eligible for the plan. In 2019, with the original Secure Act, Congress changed this rule and said that employees who had at least 5 consecutive years of 500 hours, at least 3 consecutive years of 500 hours must be allowed to be in the employee contribution section of the plan. So the employee could be kept out of receiving matching contributions or other employee contributions, but they had to be permitted to make either pre-tax or Roth deferrals to the plan. This provision has still not fully gone into effect. It began based on 2021 service. So the earliest that someone could have had 3 consecutive years of 500 hours was the end of the 2023 plan year, which means a part-time employee who had been kept out of a 401k plan would not have to be let in the plan until 2024 at the earliest. So even though the dust has not settled on this rule and people still don't really know how it'll work, Congress is already tweaking the rules. I'm not sure why Congress would do this since we haven't gotten IRS guidance on how the rules work and we haven't fully implemented the 2019 rules, but that's what's happening. Secure 2.0 changes the years requirement from requiring that an employee have 3 consecutive years of 500 hours to say that beginning in 2023, an employee with 2 consecutive years with at least 500 hours must be allowed to participate in the plan for employee contribution purposes. So going forward, there's even less time for when a part-time employee is hired to figure out how to absorb this rule and figure out how it'll be handled. Next slide. But this is where things get even more confusing. The Secure 2.0 rule with the 2-year eligibility requirement that begins in 2024 doesn't overwrite the original 2019 Secure Act rule. They run parallel to each other. What that means is that beginning in 2024, which, believe it or not, is coming very quickly up upon us, we apply the Secure 1.0 rule, which means we apply the 3-year eligibility rule, and any employee who had at least 500 hours of service in 2021, 2022, and 2023 must be allowed to participate. Then in 2025, we switch tracks to the Secure 2.0 track, and anyone with 2 consecutive years of 500 hours must be allowed to participate in the employee contribution section of the plan. I imagine that this transition period, where we're going from 3 years to 2 years, will be very difficult for employers to figure out who must be eligible for the plan, who's not eligible, and how everyone will be treated. So it's going to be one of those areas that we'll be talking about for a long time. Next slide. One of the other areas that we've traditionally gotten a lot of questions from employers about is what documentation is required for participants when they want to prove that they can take a hardship withdrawal from a 401k or 403b plan, or withdrawal for what's called an unforeseeable emergency from a 457b plan. For years, the IRS guidance on this issue was that employers needed to gather enough documentation to prove that the employee had a hardship. And this was a pretty painful process because it required the employer looking over all of the employee's finances to make sure they couldn't afford the hardship for some means outside of the retirement plan. A few years ago, the IRS came out and said that employers are allowed to rely on an employee certification that says they have these certain hardship expenses and they want to take a withdrawal from the retirement plan. The issue employers often come up with or have when they call is that they say, what do I do if I know an employee is lying? How do I say no to this employee if they're certifying that they have a hardship and I know that they're lying? So Secure 2.0 sort of responds and directs the IRS to write regulations on this rule, which will let everyone feel a bit more comfortable about it. One might say, if you know you have an employee who is lying to you about this hardship withdrawal, why are they still your employee? But that's a question for a different webinar. Next slide. One of the other popular provisions in 401k and 403b plans is the cash out limit. This limit has been at $5,000 since 1997. This is the limit on what plans can pay out for mandatory lump sum distributions for terminated small balance participants. This is an important provision for small employers in particular because they have terminated employees who are taking up space in the plan, costing fees in their plan, and this limit, if they terminate with less than $5,000, allows them to be forced out of the plan with either a rollover to an IRA or a check if they're under $1,000. So this $5,000 limit is going up to $7,000 beginning in 2024. This limit is not adjusted for inflation, unlike most of the retirement plan limits, and hasn't changed for 25 years. So it's likely that this will stay $7,000 for a while. Next slide, please. One of the few items that is not optional and is a mandatory change for retirement plans that went into effect in 2023 is the change to the required minimum distribution ages. This is the age in which participants in a retirement plan must begin receiving distributions from the plan. These distributions are called required minimum distributions, and for the year in which you turn the age in which these start applying, you have to start the distributions by April 1st following the attainment of the specified age year. That date is called a required beginning date. So before Secure 1.0 was passed in 2019, this age was 70.5 for years and years and years. This age was raised to age 72 beginning in 2020. Now, Secure 2.0, which was just passed in December, raises this age to 73 beginning in 2023, and then raises it again to age 75 beginning in 2033. So for individuals that turn 72 this year, their required beginning date is based on age 73, and so their required beginning date won't occur until 2025 based on the year in which they turn 73. If you look at the chart, here we've listed the ages. One thing to keep in in mind is you'll see this age 73 limit applies to folks who were born after 1951 and through 1959. And then for folks who were born after 1958, the age raises again to 75. This is not a typo on the slides. It's actually a typo in the law. And for folks who are born in 1959, they're listed in the law as both age 73 minimum distributions and age 75. So this is something Congress will have to figure out. But the good news is that provision doesn't apply until 2033. So Congress has some time to fix it. One of the other things that Secure 2.0 has made permanent is the disaster relief bills as it applies to 401k and 403b plans. Since 2016, whenever there's been a major hurricane or disaster or even COVID, Congress has permitted these disaster relief packages that include distributions from retirement plans. And since 2016, they've all looked pretty much the same. They give participants the ability to take a withdrawal from the plan of up to $100,000 within a certain time period after the disaster. That money can be repaid if the participant wants to. The taxes can be spread over 3 years if the participant wants to spread the taxes, and there is no early distribution penalty, which is the 10% penalty on distributions before someone hits age 59 and a half. On top of that, the loan limits are doubled from $50,000 to $100,000 for folks who want to take a loan from the plan who were affected by a disaster. And there's also a temporary suspension of loan repayments for people who can't afford loan repayments while they're dealing with whatever disaster they have. The good news here is that Congress, too fast if you could back up one slide. Congress made this permanent for all federally declared disasters going forward. So Congress won't have to pass a disaster relief bill every time, and it automatically applies to all disasters. But as part of this disaster relief, like permanence, the maximum distribution has been lowered from $100,000 to $22,000. This applies retroactively to all disasters declared after February 25th, 2021, which is when the last disaster relief bill cut off. So if someone's home was wiped out in Hurricane Ian in 2022, the plan could theoretically let them have a disaster relief distribution now. It's just an employer choice of whether the plan should implement this. Next slide. As part of Secure 2.0, there's also a brand new distributable event for retirement plans, which gives an exemption from the 10% penalty for domestic abuse withdrawals in 2024. The withdrawal is limited to either half of a participant's account or $10,000, whichever is less, and it's payable during the 1-year period following the individual being a victim of domestic abuse. The law specifically says that a participant can repay it to the plan, and more importantly, allows a participant to self-certify to the employer that they were a victim of domestic abuse. And there's a very broad definition of domestic abuse so that someone who needs this money would be able to use it to get out of whatever situation that they're in. Next slide. As you can see, there's a whole bunch of new distributable events in Secure 2.0 that deal with emergencies in people's lives. I think the concept here is that people out there are sometimes hurting, and if you give people more access to their retirement plan money during their working years, that makes it more likely that they'll save money if they think they won't be locked into that money all the way through retirement. The last piece is a new personal emergency expense distribution, which is permitted in 401k and 403b plans. It can be used for any unforeseeable or immediate financial need for personal or family emergencies. Employees can again self-certify to the employer that they need the money for an unforeseeable emergency, and the employee does not have to certify that it's for a specific distribution. The most that an employee could do for one of these distributions is $1,000 per year, and unless it's repaid to the plan, an employee can't receive another one of these emergency distributions for 3 years following the distribution. So again, it's just the concept that if you give people some access to the money, it'll give them some relief when they're really in dire straits and need money from the plan. With that, I will turn the presentation over to Jenna to talk about emergency savings accounts.
Thanks, Rom. So now let's talk about emergency savings accounts, which I'm going to refer to as ESAs. An ESA is the government solution for folks who really struggle to save. There's overwhelming proof that many Americans live paycheck to paycheck. And just to put this in perspective, I threw in some stats for you there. The Consumer Financial Protection Bureau reports that 24% of Americans have no money at all for an emergency expense, and 39% have less than 1 month of income saved up. So if your water heater goes, or if a tree falls on your car and you have a really high deductible, a lot of folks can't afford those types of unexpected expenses. So what exactly is an ESA and how does it help? Well, employers may, emphasis on the word may, allow for a different money type within the retirement plan. It's essentially a personal savings account embedded within the retirement plan, but there are some limitations to it. Next slide. An ESA can only be used with a Roth retirement plan, and it is limited to only employee contributions. However, those employee contributions are treated like deferrals for purposes of an employer match. In other words, the employer match goes into the retirement funds pot, not into the ESA pot. Also, those employee contributions are capped at $2,500 or amount below $2,500 if the plan chooses to have a lower amount. It needs to be a principal protected investment account, so it can't be an ultra high risky investment fund. And finally, highly compensated employees cannot participate. The government assumes that if you are highly compensated, then odds are you have the money saved up to afford emergency situations. Next slide. So what happens if an employee contributes more than $2,500 by accident? Well, the government has thought of this scenario and baked in a few options for plan sponsors to choose from. They can treat the excess contributions as regular Roth deferrals, or they can simply choose not to accept the excess contributions. And what about withdrawals? Well, this may be a pain point for plan sponsors because plans must allow participants to withdraw at least once per month. Yes, I said per month. Each withdrawal is treated as a tax-free qualified Roth distribution, so the 10% premature distribution penalty doesn't apply. So that's good news for participants. And another benefit for participants is they don't have to submit proof to the plan that they are actually experiencing a qualifying emergency. Instead, they can simply self-attest, which allows the participants to get their funds much faster than they otherwise could. So while there are a lot of pros for participants here, it could be costly for employers to administer because plans can't charge an admin fee for the first 4 withdrawals per year. However, after those first 4 withdrawals, plans are permitted to charge a reasonable fee. Next slide. So just a few more items to touch upon for ESAs. First, auto-enrollment is permitted, but only up to 3% of the employees' pay. And to make plan sponsors feel a bit more comfortable with testing the water, so to speak, Secure 2.0 allows employers to terminate the ESA program at any time without any anti-cutback issues. And there is a potential issue that we wanted to flag for you, and it's one that we'll definitely be keeping an eye on here at Cozen, and that problem involves the match. There's a possibility that a participant could contribute to their ESA to get the additional employer match, and then after the employer makes the match, the employee could immediately withdraw their own contribution. So the government has recognized that this could be a potential flaw of the ESA program. So employers are allowed to implement reasonable prevention measures. But what's reasonable here? Well, that's a really good question. And it's something that's still up in the air, and it's something that will likely need additional regulatory guidance on. Next slide. So enough of ESAs. Now let's talk about paper statements. Secure 2.0 says that at least one benefit statement must be provided on paper each year. However, there is an exception for defined benefit plans. Those plans only have to provide a paper statement every 3 years, and participants can always opt out at any time. Next slide. So while throughout this presentation, we've spoken a lot about what plan sponsors have to do, the Department of Labor has some homework as well. Within 2 years, the DOL is tasked with building an online searchable database for retirement accounts. It'll essentially act as an online lost and found, and this applies to all plans that are subject to a risk of vesting. And now with that, I'm going to pass it off to Jay, who will be talking about changes to defined benefit plans.
Thanks, Jenna. Appreciate it. The defined benefit plan area did not receive a lot of attention in these rules, so we'll be able to cover most of them in a short period of time. First of all, the PBGC eliminated, kind of, bear with me one sec, there we go. There we go, trying to get my video to work. Thank you. The PBGC originally provided for premiums that were increased every year by taking into account the impact of inflation. Under Secure 2.0, the indexing of premiums from inflation will end, and there'll be a variable rate premium that's fixed at $52 per $1,000 of unfunded vested benefits. This change is going into effect now, basically with the date that the statute was enacted, the end of December 2022. Next slide, please. Transfer of assets to fund retiree health accounts has been extended. This is a nice tool for those who have defined benefit plans that may have excess assets, because there really isn't much you can do with excess pension assets because of the way they're treated under the tax rules. If you do find yourself with an overfunded plan and you have more than 125% of the assets needed in order to satisfy your liabilities, then you can use those excesses to help fund retiree health and life insurance benefits by transferring a portion to an account. This has been a great option for many employers who find themselves with these assets and the need to fund these costs. But the option was expected to expire December 31, 2025. Well, Secure 2.0 did two things. It extended the date these transfers will be permitted to December 31, 2032. So that's really good news. It also made it a little bit easier and made this more available to employers, because it now provides that if the amount that's going to be transferred to these accounts will not exceed that 1.75% of the plan's assets, then someone who has a defined benefit plan with excess assets of only at least 110% of the liability instead of 125% can take advantage of the option. So at the end of the day, this is good news for employers. Next slide, please. Lump sum window disclosures. First, let's talk about what is a lump sum window. The way lump sum distributions are calculated under the law, sometimes it's more beneficial from an employer's perspective and more cost effective to allow certain populations of participants to basically take their benefits in the form of a lump sum instead of an annuity. Now, normally this is done with a very limited period, hence it's called a window. And the way this is typically done, there might be an instance during the life of a plan where the employer is trying to reduce their liabilities, so they offer this window. Or secondly, this is frequently done just before a plan is terminated, again, in the hope of trying to reduce liabilities by individuals choosing a lump sum distribution at a time when the lump sums are less expensive to provide than an annuity. Now we have Secure 2.0 coming into the Act, and it adds a number of additional requirements. First, participants are going to be required to get certain disclosures at least 90 days prior to the window opening. So that means that the whole process of providing a window is going to be much longer than typically is the case. So we'll have a disclosure to participants. But now there's also going to be a requirement that 30 days prior to the window opening, certain information is also going to have to be submitted to the Department of Labor and to the PBGC. And once the window closes, another report is going to have to be provided to the Department of Labor and the PBGC within 90 days. So this really, in my view, is an attempt by the Department of Labor and the PBGC to begin getting involved in the regulation of these types of windows. So we're going to have to see what, in fact, they do with this information. I think this is something that it's one of these stay tuned if you're going to want to consider doing these windows. Generally, these rules will be effective 1 year after final regulations are issued on how this is going to work. But the Department of Labor is required to publish the regulations no earlier than December 29th, 2023. So we're generally talking about this applying in 2024. Next window, please. Next slide, please. Mortality improvement rates. Secure Act 2.0 inserted a cap on the rate in which mortality can be projected to improve at any age. for purposes of determining the minimum funding requirements. Ultimately, this is helpful in terms of reducing the liability potentially that might otherwise be the case, as mortality tables and the issue of whether people are really living longer or shorter is debated. This change is effective December 29th, 2022 for valuations occurring on and after 1/1/2024. Next slide, please. Cash balance plans can use a variable interest crediting rate that uses what's called a reasonable projected interest crediting rate up to a maximum of 6%. This provision specifically is intended to deal with backloading rules that apply to cash balance plans. And by adding this new provision, what it's hoped is that it will reduce the likelihood of someone not satisfying those rules and having to have a cutback in benefits. This is effective for plan years beginning after December 29th, 2022. Next slide, please. The annual funding notice that defined benefit plans have to provide is going to be significantly broadened in terms of the kind of information that's going to have to be provided, dealing with the funding status, its plan assets, liabilities, a lot of other fun information. This is going to be effective for plan years beginning after December 31, 2023. Next slide, please. And finally, critical question is, okay, you've been listening to all these presentations and we've been giving you a lot of detailed information, and you've noticed that there's been a lot of different effective dates for the different provisions. I think part of that ties into budget issues, how expensive the bill will be, how expensive these different provisions are when they come into effect, how they affect the overall budget. I think it's also, there's also a concern of how quickly the government can get up to speed to regulate these provisions and to provide guidance, and not only to the public, but to the regulators as well. In order to be sure plans retain their tax qualification from time to time when there are new changes in the law, the plans sometimes can operate in accordance with these provisions, but they don't have to necessarily put them into their plan document for a while. In this case, the statute provided that these various provisions don't have to appear into plans until the end of the first plan year beginning on or after January 1st, 2025. So for a calendar year plan, you're talking about having to get these amendments into your plan at the end of December 2025. Generally recommend that you wait, quite frankly, till late in the game so that you get the opportunity to take into any additional guidance, changes, or revisions. As Rob noted, there's a typo that Congress is going to have to fix. And we also noted that in some places, there is going to be a lot of additional guidance to come out. And I think that would be appropriate to be considered. In addition, in a number of cases, regulatory agencies have been charged with coming out with model amendments that you would be able to use, and that would help reduce the cost of doing this. So I generally would suggest waiting sort of later in the process to actually amend your plans to put these into effect. With that, that's the end of our presentation. First of all, thank you for hanging in with us. And I think we're going to enter into a session of Q&A.
Yeah, thank you so much, Jay, and everybody else. It's pretty clear that they just don't make it easy for employers, do they? This is so complicated. All right, we have some questions that were submitted a little bit earlier that we'll try to get to as many of these as possible. So the first one I have here for you guys is the online searchable database, the DOL, is going to establish appears to only let participants do searches. What about employers?
I can touch on that. I was at a conference recently where someone had actually raised that similar question. And it was raised to people who are, in fact, it was raised to regulators from the Department of Labor who were presenting. And they basically said, well, yeah, for sure, we're going to ultimately want to have employers to have the ability to do that. The statute doesn't really say that. But there are a lot of things that they're going to be having to provide additional guidance on and to sort of fix a few things that the statute doesn't necessarily addressed properly. And that's because it was done fairly quickly, given the breadth of the statute.
Okay, the next one is I think you touched on this already. What are my responsibilities as plan administrator versus those of our TPA?
Someone want to take that?
If it's too broad of a question, I know that this is a pretty broad question. We can move on to the next one.
A broad question, but if it's related to what's the requirement for these provisions we just talked about, it's ultimately the employer's responsibility to decide which of those they're going to adopt, or in those cases where they need to, they have to move forward with the adoption, but the actual steps that'll take place will need to be helped by a third-party administrator if they have a prototype plan.
Okay, very good. The next one is, does this apply to nonprofits?
Yes. If they have a plan that's covered.
Every
Yeah.
type of,
Yeah, there were a couple provisions we mentioned that are only applicable to ERISA plans or church plans. They wouldn't, some of it wouldn't apply for, but you have to look at each provision individually.
okay, great. I'm not sure if you can answer this one. You guys tell me. Was there an update regarding 529s, which allows 35K or some other amount to be placed in a Roth without a tax penalty?
Yeah, so I can take this one. This one's an interesting one. One of the things that sometimes stops people from saving into a 529 plan is they're afraid that their kid is going to get a scholarship or won't go to college, and then all of a sudden they'll have excess money in the 529. So there's been a lot of talk that this is a windfall and a way for people to save $35,000 free into a Roth IRA. It's more confusing and more tricky than you may think, which is for folks who have had 529 balances or an account with a 529 for more than 15 years, you are permitted to transfer 529 balances into a Roth IRA for the beneficiary, not for the 529 owner or the parent, of up to the Roth IRA contribution limit, with a lifetime cap of $35,000, right? And bear in mind that also takes up the beneficiary's Roth IRA contribution for that year in which they do it. Right, so it's a little bit complicated, but basically if mom and dad have a 529 with too much money into it, and they can't use that money for college, they can open a Roth IRA in the child's name or whoever the 529 beneficiary is, and contribute the Roth IRA limit, which this year is $6,500. And that would take up the child's Roth IRA contribution for that year. And there's a lifetime cap per 529 of this $35,000 cap.
Okay.
So
That is
sorry for the complicated answer.
Oh no, it's great. There were some questions that were going back and forth during the presentation, so I'll make sure to include the questions and answers in the follow-up email. Somebody asked if you guys will see this presentation. I'll send a copy of this recorded presentation and a copy of the slides that you guys saw here today in the follow-up email, along with the SHRM and HRCI credit codes. And I think that wraps everything up. Thank you all so much for being here. I hope you come back to give us more information as we learn more and we can dive a little deeper into those issues. But thank you so much for being here. We really appreciate it.
Thank you. We appreciate the opportunity to speak to your colleagues.
Absolutely. All right, everybody, have a great afternoon. We will see you next time.
Thank
Bye-bye.
you. Bye-bye.